Bloomberg Audio Studios. Podcasts, radio, news. This is Bloomberg Intelligence with Alix Steele and Paul Sweeney.
The real outperformance has been in U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alix Steele and Paul Sweeney on Bloomberg Radio.
On today's Bloomberg Intelligence show, we dig inside the big business stories impacting Wall Street and the global markets. Each and every week, we provide in-depth research and data on some of the 2,000 companies and 130 industries our analysts cover worldwide. Today, we'll look at why the tech giant Microsoft says it will cut 6,000 workers. Plus, we'll discuss how President Donald Trump is looking to lower drug prices in the U.S. But first, we begin in the legal space. Recent research by Bloomberg Intelligence maintains that the Supreme Court would likely let President Donald Trump fire Fed Chair Jay Powell, even if market reaction discourages it. It's the subject of a BI piece titled SCOTUS would likely let Trump fire Powell, even if the markets don't. For more, co-host Alix Steele and I were joined by the piece's author, Elliott Stein, Bloomberg Intelligence Litigation Analyst. We first asked Elliott if it is constitutional for President Trump to fire Fed Chair Powell.
We're not sure yet, but the way
in theory,
the way the law is playing out is, he's taking a very expansive view of executive authority and what the president can do. We see it with the tariffs, we saw it with DOGE. He's taken a lot of actions that presidents haven't done before, and they're being litigated. And one of the things that he's done is that he has tried to exert a lot of control over what used to be called independent agencies. So things like the FTC, the Federal Trade Commission, the NLRB, the National Labor Relations Board. He has removed commissioners at these agencies, even though the statutes that govern these agencies have what's called a for-cause removal restriction, meaning the president can only remove them for cause. And he's just, firing them at will. He's also obviously threatened to do the same with Jerome Powell and maybe other members of the board. And his view is that the for-cause removal restriction is unconstitutional because it impinges on his power as the president under Article 2 of the Constitution to essentially oversee the entire executive branch. And the Supreme Court in 1935, there's precedent saying those for-cause removal restrictions are constitutional, but more recently, the Supreme Court has sort of tried to narrow that precedent and said, at least with a couple agencies where you only have one director, those for-cause removal restrictions are unconstitutional. And so the President Trump, is sort of trying to expand that recent precedent to these other agencies.
So do we have other, so the Federal Reserve is one thing. Do we have other agencies that are in the legal process now where someone's been removed and we have a suit?
Yeah, exactly. We actually have quite a few of them.
Okay.
He has fired 2 commissioners at the FTC. Those are in litigation. Sort of the most procedurally advanced cases at this point are cases where he fired commissioners at the NLRB, the National Labor Relations Board, and also the Merit Systems Protection Board, which sort of oversees federal employees and whether they're being fired and hired for merit or not. Those 2 cases, we have actually several rulings, and what's interesting is that the judges in those rulings sort of fall along ideological lines in how they rule. So the trial court judge was a judge appointed by President Obama, and she said that the firing of those commissioners was improper, that it was, it violated the for-cause removal. Those cases are now on appeal. There's going to be an argument next week, but we have sort of preliminary rulings from the appeals court. One panel of 3 judges, 2 of whom were appointed by Republican presidents, said that President Trump would have been likely to succeed on the merits. But then that ruling was then revisited by the entire court, which is dominated by judges appointed by Democrats, who said that the firing was improper. So we're sort of seeing how this might play out.
Are we really in a truly partisan judicial world, or is this just simply different interpretations or stricter or looser interpretations of the Constitution?
It depends on the issue.
Okay.
I would say on this issue, it seems like the judges are essentially ruling along ideological lines, where you have judges appointed by Republicans saying that the for-cause removal restriction really does impinge on the president's executive authority. And you have judges appointed by Democrats saying, it's okay to put some limits. The for-cause removal restriction would still allow the president to fire someone if they did something improper.
In terms of, say, the Supreme Court issuing a ruling that then is ignored, is there precedent for that, like over history?
Well, we've actually sort of seen it with TikTok, right? Where the Supreme Court upheld the TikTok ban, and the president instructed his attorney general to ignore the ruling and ignore the ban. So we have sort of started to see some issues like that. But in this case, I expect the Supreme Court to, on this issue generally, I expect the Supreme Court to side with President Trump.
Interesting. So what happens when a president defies the Supreme Court, like in TikTok? Nothing, right?
So far, nothing.
So TikTok's still up and running?
The remedy is for Congress to impeach the president and then the Senate to convict. Highly unlikely in this political environment.
But he also pushed out right? It sort of feels very blurry. It doesn't feel like he completely ignored it. It's just we're working on it. We're just pushing out the deadline. That feels a little different.
That's essentially what he's doing. But at the same time, there's a law that Congress passed that said, it has to be banned by a particular date. Mm-hmm. The Supreme Court upheld that law, and he's essentially ignoring the details of the law. I agree with you. He is using that as a reason, but the law is still on the books, and it's in violation.
Our thanks to Elliott Stein, Bloomberg Intelligence litigation analyst. We move next to some of the news in the aerospace industry. This week, we heard that China has removed a month-long ban on airlines taking delivery of Boeing planes. And this follows a breakthrough in trade talks between the U.S. and China that temporarily slashed tariffs on each side. The resumption of deliveries to China will be an immediate boost to Boeing, with around 50 Boeing jets to be delivered to China this year. For more, co-host Alix Steele and I were joined by George Ferguson, Bloomberg Intelligence Senior Aerospace, Defense, and Airlines Analyst. We first asked George for his take on this week's news.
I think what it means for Boeing in the short term is that they could probably get some of these inventory airplanes they've built. They're sitting on tarmacs. They're maintaining them. Cost Boeing a lot of money. They can get them delivered into China. Cirium expects 34 of those airplanes to go in through the remainder of the year. They can get them delivered into China, get them off their books, sort of get rid of that extra expense it costs for them to manage those airplanes, so they can just get on to focusing on the factory floor and building brand new airplanes. So I think it's a positive. We'll see how long it lasts, but it's definitely a positive.
Was this sort of baked into the U.S.-China trade talks, or was this irrespective? Do you have an idea?
Now, I'm not sure what's baked into the U.S.-China talks. I do think that there's an opportunity here for Boeing to get to even new orders from China. We haven't really seen material orders out of China since 2018, so last decade before the pandemic. Relations have been a bit strained since then. I think it's one more piece of evidence that shows, look, as the U.S. and China get into negotiations over trade, you're going to see heavy fracturing, and then we see the markets kind of get very distressed about that. But behind the scenes, there's discussions about putting that relationship back together, and Boeing probably factors in high in those negotiations. And so I think you could go from hey, there's despair here, to, hey, look, there's a 300 airplane order for Boeing coming out of China. So it's going to be a real up and down, I think, roller coaster here.
George, are there airplane manufacturers in China, or do they depend solely on Boeing and Airbus?
They depend largely on Boeing and Airbus. There is a manufacturer, Comac. They've been building a 737 A320 substitute They call it the COMAC C919. The airplane's rolling out slowly. I think we saw 15 or 20 deliveries last year. This is a country that probably needs at least 150 narrow bodies a year, so not going to fulfill all their needs. There's about that many flying right now, and when we look at the flying statistics for that airplane, it's not flying as frequently as A320s and 737s, so it seems to us that the maturity of that product isn't there yet for the Chinese to substitute out all of the Western jets.
Right. So there's still a little bit of a way to go. You also have to wonder, just in general, the comeback that Boeing has been able to make. George, how would you describe the situation that Boeing is in now versus a couple years ago?
Yeah, I think this year is what we expected last year to be before the door came off the door plug in the Alaska jet. We're starting to see good flow through the factory and the delivery numbers we've seen. We're starting to see them deliver that inventory of built airplanes, like I said, that drag on cost pretty heavily. We're hearing good things about supply chain. They're going to pull Spirit Aerosystems into Boeing by mid-year. That was a big part of their problems. I think pulling them in helps them control quality at Spirit. So I think this story this year should be all about improving quality, improving throughput in the factory, in the back half, some good cash generation. So I think this year is what everybody thought last year would be, which could be a pretty good year.
So where are you, George, in your model in terms of 737 kind of build rate here? Because I know that just, with the economic model for Boeing, that just drives cash flow. The more planes they can get through the line.
We're looking for like a 45 to 50% increase in 737 deliveries this year. So a really heady increase. And again, that's going to be the big driver of cash generation for the company over the year. And probably the exit the year, a build rate per month of 38, we think even maybe into the 40s kind of build rate, which is an area where they should be able to generate some profits.
Our thanks to George Ferguson, Bloomberg Intelligence Senior Aerospace, Defense, and Airlines Analyst. Coming up, we'll continue with more on the plane maker Boeing, which landed its biggest ever aircraft order. You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries. You can access Bloomberg Intelligence via BI Go on the terminal. I'm Paul Sweeney. This is Bloomberg.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
We continue with more news from the plane maker Boeing. This week, Boeing landed its biggest ever aircraft order, with Qatar Airways agreeing to purchase up to 210 wide-body aircraft, including the 787 Dreamliner and the 777X model. It's a deal worth $96 billion. And this comes a year after Boeing slogged through a deep executive shakeup and prolonged crisis. For more, co-host Alix Steele and I were joined by Sid Philip, Bloomberg Deputy Team Leader for Global Aviation. We first asked Sid for his take on this week's news.
This is a significant deal for Boeing because they can sort of add another sort of milestone order to their backlog, especially for their 787, which is their sort of state-of-the-art wide-body jet, as well as potentially for the 777X, which is, again, a jet that Qatar Airways has ordered and is still to be certified. And so as airlines sort of look to the next generation of aircraft that they're looking to order, you're going to see these mega deals coming up where everyone's looking to sort of replace their current generation planes with newer models which are more advanced, better fuel economy. And that's sort of great for Boeing in terms of just building out that backlog and sort of selling out aircraft past the end of the decade.
What is the delivery time for something like this? Boeing has clearly had some operational and execution issues.
Exactly. I mean, Boeing's been struggling to deliver both the 787 as well as 737 MAX and get the 777X, which is their latest sort of generation aircraft, certified. So we're still not clear on the details for what the sort of intricacies of this Qatar deal are, but potentially these will sort of play out and go out into the next decade because, I mean, they've got a significant backlog of aircraft that need to deliver in the short term. So this is not going to be an aircraft deal that sort of happens in the next 2 or 3 years. It's going to be a drawn-out deal that goes into the next decade.
Well, Boeing's finally digging itself out of its hole from the last several years. So that kind of goes to the big question, Sid. It's all about production, getting planes off and people just said, like George Ferguson from Bloomberg Intelligence says, just focus on the 737 MAX deliveries. That's the number. Is there a sense that Boeing's making improvements there?
We have seen Boeing deliveries inch up, and they've had sort of a milestone in terms of just hitting better production levels on the 737. And we've heard from airline customers, including United Airlines, saying that the deliveries of 737 MAX are sort of going up, and they're waiting on the 787, which is the aircraft that we understand that Qatar Airways ordered. That's also going to be sort of key to getting production and profitability going.
What other kind of pitch can Boeing make to outstrip Airbus? Because in a duopoly market, and I appreciate that China has some smaller players, but if you're dealing with a duopoly, people got to buy your planes.
Exactly. We have a duopoly at the moment, and
does that change at all, you think?
It sort of has changed a little bit in terms of just the sort of, there's a lot of politics behind aircraft orders again, and that's something that we've seen where Trump's been announcing these mega Boeing orders. He announced a deal for 30 planes in Saudi Arabia. And so there is a lot of politics attached to aircraft orders. But at the same time, both Airbus and Boeing are sort of sold out of aircraft until the end of the decade. So it is sort of, you're notching up all these orders, but at the same time, the biggest thing that airlines are talking about is, give me my plane, because that's really the biggest question, where airlines are saying that plane deliveries are delayed, and the Airbus has repeatedly talked about how supply chain issues continue to haunt the industry now 5 years after the pandemic.
Yeah, which I can't imagine. Although, again, what I understand is one of the bottlenecks is labor. Getting the this is not just sitting in an assembly line and hitting a hammer. You got to be really, really skilled at labor. And during the pandemic, you lost a lot of that. And retraining these folks or getting new people in, I'm hearing that's a big problem.
Labor is a major problem, as well as, just one part being short holds up the entire production line. You have millions of parts that go into an aircraft, and Airbus and Boeing are the final assembly lines where the plane actually gets put together. But then if parts are not available in the sort of process, you can't actually build those planes. And that's where the bottlenecks come up, because you have smaller suppliers who are struggling financially. You've got parts in short supply. Airbus talks about it's whack-a-mole, where you get one part sorted out and something else breaks. And so it's really a question of getting that supply chain to sort of hum along nicely, and then actually building those planes and delivering those planes, because you've now got record backlogs at both Boeing and Airbus.
So are they exempt from tariff issues?
That's, again, a really important question no one's quite clear about in terms of what the tariff impact is going to be, because for 50 years almost, that the aviation industry has largely functioned tariff-free. And the tariffs added complexity to it, because now everyone's not quite sure if aircraft are exempt. You've seen all sorts of industry players and industry groups making representations to President Trump saying that we would like to have tariffs removed on aircraft and aircraft parts. And so we're trying to see where that sort of actually lands up, because potentially aircraft manufacturers and airlines may have to pay tariffs on planes depending on where they're made and what parts they have.
Our thanks to Sid Philip, Bloomberg Deputy Team Leader for Global Aviation. We move next to news in the tech space. This week, we heard that the tech giant Microsoft will cut 6,000 workers across the company to reduce management layers. This will amount to less than 3% of total headcount. For more, co-host Alix Steele and I were joined by Anurag Rana, Bloomberg Intelligence Technology Analyst. We first asked Anurag for his take on why Microsoft is cutting jobs.
The numbers 3% does not say much, but at the same time, Microsoft is not hiring at the same pace that it used to. And I think one of the areas where it is deploying AI is coding or R&D. That's an area where we anticipate productivity to improve because of the tools we have and not anticipating headcount to grow up. Second thing, Microsoft is investing very heavily in AI right now. The CapEx is going to be extremely high, as north of $80 billion for the next 12 months. And that they have to offset some of that pressure on gross margins with cuts on the operating expense side, so that the net operating margin doesn't get impacted. So I think it's a little bit of all the above.
Was this a surprise?
Not really. I mean, 3% to me does not come as a surprise. 3% is, in an environment like right now where companies are not anticipating the real attrition rate. So on a normalized basis, if a company is seeing employee attrition between 10 to 15%, we're not seeing that right now. So the company has to do something in order to get back to the normal range of their financial planning. So as I said, this doesn't sound too much to me, but there could be a little bit more based on, who they are trying to get rid of. If it's higher on the paychecks, then I think it has to do with, protecting your margins.
Anurag, talk to us about just what the investment thesis is regarding Microsoft right now, given some of the tariff uncertainty, given some of the geopolitics uncertainty. What's the call on Microsoft these days?
For the last few years, we have been saying this is probably one of the cleanest stories in AI and software land because it doesn't get impacted with tariffs. There is some marginal secondary impact because of, if we do get into an economic slowdown. But the real benefit for them is they are hosting ChatGPT, the most favorite app of consumers right now, and they get the benefit of that. So if you have, let's say, your user base goes from 200 million users to 300 to 400, now we are close to about 500 million users. It really helps Microsoft because they are hosting that app. And as those users use ChatGPT for a longer period of time, they get to make more money. So I think that's really one of the bigger benefits where they are offsetting the risk that we are seeing that other software vendors are seeing because of the lack of headcount growth across the tech landscape.
So based on that, do we think that we're going to see other tech companies follow suit in this particular way? Like if Microsoft is a creme de la creme, as you see it, who's next?
So, Alix, when you look at it, as I said, 3% does not scare me as much. But if over the next 6 months, companies come out and say, well, I'm laying off like 7 to 10% of my workforce, that is concerning because that's concerning for two reasons. One, these companies do buy software from other companies, such as a Workday or a Salesforce, because these two companies are seeing some pressure on their seat growth because their end customers are not hiring as much. So lack of hiring is a concern, not just for the companies or the industry themselves, but for the software landscape as well, because primarily this is a seat-based, monetization model.
Anurag, before we got all enmeshed in tariffs over the last few months, we seemingly talk to you every day about the AI story. That's kind of fallen off the radar screen a little bit here for, I think, Global Wall Street. Not for you guys. What is the AI story today? What's the feeling in the marketplace about AI as a growth story for tech?
Yeah, one of the things DeepSeek did for the entire space was divided the space in two different buckets. One was the AI infrastructure play, and the other one is more on the application side of it. And Microsoft, I think, guided them a little bit towards that framework because when you look at it, Microsoft is really focused on the inferencing side of it, which is hosting the applications. Things that are more on the infrastructure side, whether it's the chip building from NVIDIA or a recent IPO like CoreWeave, they have not done as well as some of the other vendors because people are wondering, why do I need to play the infrastructure game? Because it's CapEx heavy and we do not know how things are going to shape up in the next 2 to 3 years. One thing is sort of certain that even after 3 years, the number of use cases on AI is going to rise. So you want to be on the application or the inference side of things rather than the infrastructure side of things.
Right. And that's going to be a lot more profitable going forward, but it also requires something very different at the end of the day, right? You're going to have basically locations that are closer to the actual use point, right? So closer to where I am and where you are versus out in the middle of nowhere, but you have a huge heavy load. How does that change either investment or power usage, et cetera?
That's probably one of the most important questions out there right now. So somebody like a Microsoft is saying, for my training needs, I will go to those data centers that are out in the boondocks and middle of nowhere. And that could be my data center, or I could lease it from somebody like a CoreWeave. But for the application side, I'm going to create or lease smaller data centers that are well connected, where I'm going to do the inferencing or, from the user point of view.
Our thanks to Anurag Rana, Bloomberg Intelligence Technology Analyst. Coming up on the program, we'll break down how the Chinese AI startup DeepSeek became world famous. You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries. You can access Bloomberg Intelligence via BI Go on the terminal. I'm Paul Sweeney. This is Bloomberg.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
We move next to news in the pharmaceutical space. This week, President Donald Trump signed an executive order to lower drug prices in the U.S. The order asked drug makers to lower prices voluntarily or face regulatory measures. Pharmaceutical companies had expected and feared action on drug prices. However, the order was far weaker than they anticipated. For more on drug prices, co-host Alix and I were joined by Sam Fazeli, Bloomberg Intelligence Director of Research for Global Industries and Senior Pharmaceuticals Analyst. We first asked Sam to walk us through why we pay more for drug pricing in the U.S. and whether that should be reduced.
The thing in the U.S. is that it's a price that's set by negotiation between pharma companies and insurers, pharmacy benefit managers, and payers. It's not dictated by the government. At least it wasn't until recently. Whereas in Europe and many other countries, you have a single payer, and that's the government, and they play hardball. So they can get lower prices because that's the way they operate. And there are many situations where in the UK, the National Institute for Clinical Excellence refuses to believe or accept that a drug has got is value added. So it's not even offered, even at the negotiated lower price. So that's the issue here, which means that as soon as innovation happens, it's out in the market in the US. The day that a product is approved, they can get on and sell it. Over in Europe, it could take a year, 2 years for a drug to come through. So, and maybe with this new executive order, sometimes the companies will go, well, I'd rather not launch in Europe.
So is it realistic to expect that drug prices in the U.S. will come down, could come down?
See, the thing is, Paul, I'm having a tough time balancing this out. If the intention is to get the rest of the world to pay more, which of course helps the pharma companies, then I don't see how that helps the U.S. drug prices come down, right? If they aren't able to increase prices in Europe, then the government in the US is saying, well, you should give us the same prices you're giving elsewhere. Then innovation disappears, because at the end of the day, if you cut your revenue by half, you won't have, you spend 15% of that on R&D, guess what? Your R&D falls. Simple maths. So how this plays out would be quite interesting to see. And of course, we have to also remember that there isn't a price in Europe. So we just checked the price of Wegovy in the UK at the effective dose, $230. Okay, in the US, Novo sells it for $499 to the direct to consumer. Okay, it's about twice as much. Okay, so let's say in Europe it goes up to 300 or in the UK. How does that change with the US number? And we don't even know whether the company actually gives that price, because then there's a little small print. We have been doing the NHS has done a commercial deal. So what is the price? How is the US government going to find that price? Unless they incorporate it into the trade agreements that they're doing, which is what should be happening here.
So so what about the PBMs? So that was singled out, the pharmacy benefit managers, as sort of the middlemen between insurers and the government and the drug makers, et cetera. What role do they really have? And are they the ones most at risk?
I would say they are the ones most at risk. I would say they should have always been the ones most at risk, because I don't understand the reason they exist in the middle. I mean, that's I can show you a chart of how the U.S. payment system works, and it varies by insurer. You can go from one job to another, and the cost of your drug goes up, right? Because you have a different insurance, or from one state to another. So that just really is untenable. And it's nice to see that the government administration is now talking about making it easier to sell directly to consumers. So let me give you an example. We have data on the terminal that gives you an ability to calculate what a drug revenue should have been in the past quarter. Volume times price, right? Then you go and see what they actually reported. Sometimes for insulins, for instance, is 80% lower. 80%. Now, the PBM say, oh, no, we pass that on back to Medicare Part D. Why do you even take it? Why do we need to pay an administrator in the middle here?
That's a great question.
What are your companies within your food chain there in the big pharma, what are they saying? Because this issue is new. We've been complaining about high drug prices forever. What are they saying as to what is likely to really happen?
they're not saying very much, Paul. And in these sort of circumstances, the best thing to do is to keep your head down and see how things work out. And of course, today it's only just come out. So I think they all, to a T, say the PPMs are a problem. We need to get rid of them. That's what, let's say that. But that's not today. That's been going on for 10 years. They also say Europe should pay more. But they also say that when you do the net price calculation, in many instances, I actually sent you a quote from Pascal Soriot, the AstraZeneca CEO, saying that actually in many cases the prices end up being about the same, maybe a little bit different. So all of that needs to be taken into account. And we need to decide if they're going to push Europe higher to pay more, is the US also happy to move some of the R&D to Europe? Maybe that's something that the European governments will ask for. Fine, we'll pay more, but bring some of your R&D here. Right. Bring more manufacturing here.
Our thanks to Sam Fazeli, Bloomberg Intelligence Director of Research for Global Industries and Senior Pharmaceuticals Analyst. This week we focused on a Bloomberg Big Take story entitled DeepSeek's Tech Madman is Threatening U.S. Dominance Over AI. You can find it on the Bloomberg.com and the Terminal. The story looks at how Chinese AI startup DeepSeek became world famous and swallowed $1 trillion of stock value from NVIDIA and other big tech companies. For more, co-host Alix Steele and I spoke with Austin Carr, Bloomberg technology reporter. We first asked Austin to give us more background on DeepSeek and the individual behind it.
DeepSeek, as you'll recall, gained a lot of attention a few months ago when it released its new R1 reasoning model, as well as another one called V3. And the big deal about this was they sort of claimed to have trained it without access to a lot of the most cutting-edge NVIDIA chips. And they also trained their models for a lot less, at least on the surface, than a lot of the models, equivalent models here have been trained in the US. And that raised a lot of questions about, some of the fundamental notions about how many chips are needed to train these big AI models and how much it's going to cost to develop them. The reason it was also a big deal was just because the startup was sort of very mysterious. There had not been much written about them before sort of January 2025. And we spent a lot of time the last couple months talking to about a dozen former employees that worked for this company and its founder, Liang Wenfeng, as well as 40 sources close to the Chinese AI scene, to really just give you a sense of how their sort of market is developing very differently than what's happening in the US, which is they're doing a lot more with less and sort of just trying to innovate despite the constraints that the US has placed on it with all its export controls.
How did he do it? How was he able to undercut the price in such a tremendous way?
Well, I think that's one of the big topics that we explore in the story. We trace it actually back to the history. Liang Wenfeng had started a quant fund back in the about 2015, 2016, and you actually see a lot of those sort of quant sensibilities, looking for efficiencies in the market, which they later applied to their AI models. It was sort of a sort of spin-off of what they were doing with that quant fund that became DeepSeek. One of the big things they did was called mixture of experts. Basically, a lot of the sort of when you used ChatGPT back in the day, you asked it a question, it activated the entire model. So think of that like your entire brain is activated just for the question 2 + 2. What DeepSeek did that was a little bit different was chop it up into what are called experts. So every time you ask a question, it actually routes that to the particular part of the brain that is expert in math or expert in physics or expert in cooking, what have you. So it's a lot more efficient approach, but the downside is it risks hallucinating more or perhaps sending the question to the wrong part of the brain. But that's one of the techniques that they use to really bring this model to life for a lot cheaper and according to the DeepSeek with a lot less or a lot fewer of NVIDIA chips than a lot of the Western players like OpenAI have access to.
I guess one of the things that surprised people, maybe scared some people, is how DeepSeek was able to make so much progress when supposedly all these Western sanctions on technology going to China didn't really seem to slow it down at all. What's the status there?
I think that's one of the big ironies. Actually, incidentally, I had interviewed Jensen Huang from the CEO of NVIDIA in May 2023, and that was the very month, coincidentally, that on the other side of the world, China was getting started with DeepSeek. And Jensen told me at the time, one of his big concerns about export controls is it's actually just going to incentivize Chinese chip makers to work a lot harder to develop chips that can compete with NVIDIA's. But the other nearer-term threat is actually software makers. Sort of their constraints from the sources that we've talked to close to DeepSeek are actually what really drove this company to develop workarounds, do a lot more with less. And that's become a sort of founding DNA of a lot of the Chinese startups that we've talked to. A lot of these, what are called AI dragons across Beijing and Hangzhou, that are doing a lot more with a less access to compute. And I think that's, I think the other sort of component of that is they almost have this national pride that we've heard resonate throughout our interviews that really doesn't exist in the US in quite the same way. No one's, quite as excited, or, we don't think of Sam Altman necessarily as a celebrity as the same way as in China. People descend on that campus, the DeepSeek office, just to see pictures of him. He's like a national hero there just because he's able to overcome these constraints. And I think that's a really interesting component of the AI scene in China, which we don't have quite in the US.
So about 45 seconds here. What's to prevent the AI companies here in the US doing the same thing that DeepSeek does?
There's really not. I mean, that's one of the things that, they did make their models open source for the most part. They did, unveil some of their secret sauce, but they didn't quite explain all the techniques and how they did them under the hood. But that said, yes, I mean, that was part of the really compelling things. By making this model open source, they really have this ethos. One of the first quotes they put with their first public announcement was, "Talk is cheap, show me the code." And so they have this really aggressive, let me prove it to you attitude that I think in the US space with these proprietary models, they're not willing to do. And I think the difference here is that DeepSeek having an open source approach is really putting the pressure on Google and OpenAI to do something similar, or at least undercut the costs of their models. I mean, you can get the same computing power for $36 through DeepSeek as it would cost $1,000 in OpenAI.
Our thanks to Austin Carr, Bloomberg technology reporter.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.